Hello and welcome to Upstack America's Oracle Financials Functional Training. My name is Bob and I'm the lead senior consultant at Upstack America. And with me today I have Victor, who is also senior consultant. And today we are handling lesson 2 of fixed assets module. And Victor, please walk us through.
Thank you, Bob, for the introduction, and welcome everybody to this lesson in our Financials Functional Training series. In this lesson, we are going to talk a bit more about depreciation. In particular, we are going to talk about some depreciation methods, and we are also going to talk about the accounting that's created for depreciation entries. Okay, so that is our main aim for this lesson. So just going back a bit, let's remind ourselves what we said depreciation is. Depreciation basically allows a company to write off the cost of an asset over its useful lifetime. Okay, so we talked about how some assets are usually capitalized and others are expensed. When you capitalize an asset, then it means that you calculate depreciation expenses for it over a certain period of time, which is its useful lifetime, right? So every period, a certain portion of the cost of that particular asset is calculated as a depreciation expense until the whole portion of the depreciation of the original cost is expensed out. So before we talk about depreciation methods and the accounting, I want us to talk about some terms and definitions that we're going to be using, just so that we can have a clear understanding. I know some of you might already know what this means, but let's just look at them and so that we can all be on the same page. So let's start with the original cost, and this is the amount that is paid to acquire the asset. So for example, if the asset we're talking about is a car, this is the money that you pay at the dealership or where you purchase the vehicle, or the money that you pay to maybe the manufacturer of a particular machine, and so on, right? So that is the original cost. So the other term that we're going to be also dealing with is the book value. And we can define the book value as the value of the asset as shown on the balance sheet account, all right, or on the balance sheet. So what this definition does not say also is that this book value amount is obtained by taking the original cost and removing the depreciation, the accumulated depreciation up to that particular point. All right, and we are going to see an example of that. So as we have said, original cost is the amount paid to acquire the asset. So when you acquire the asset and you put it in use, then you'll start to calculate depreciation expenses for it. Okay, so at every particular point, there's a certain amount of depreciation expense that you'll have calculated. So that the original cost minus the total depreciation that has accumulated up to that point is what we call the book value. So it is basically the mathematical value of that particular asset when you subject the original cost to the whatever depreciation method that you're going to be using for that asset. All right. So even when maybe you've had also like people like brokers, people who deal in stocks, you can hear like a stock has a book value, but it also has the actual price which is it's trading at. So the book value is the actual mathematical like value when you calculate using the original cost and whatever depreciation method is being used, but that may also differ from what people actually think is the value of is the true value of that particular stock. So that is the meaning of the book value. Salvage value is the value of the asset at the end of the useful life. So as we have said, the asset will have a particular useful life after which it is going to be maybe disposed of. So you can resell some of these assets. For example, maybe it's a vehicle that you had acquired for your company, which is the asset. You have used it up to a particular mileage, and up to that point, maybe it's more expensive to keep that vehicle than to just sell it and acquire a new one. Maybe the maintenance costs have gone too high or something like that. So anyway, when you sell that vehicle, you get some money at the end, all right? So that money you get after selling that asset is what we call salvage value after you're done with it. So depreciable cost is the portion of the original cost that will be depreciated. What do we mean by that? In order to understand that, let's look at this next slide, which shows some equations. So we have this original cost minus accumulated depreciation is what we have said will give us the book value. Original cost minus salvage value is the depreciable cost. All right. So this is the price that you pay to acquire the asset, and this is the value of the asset at the end of its useful life when you uh, sell it. When you sell maybe the used vehicle or whatever. So when you take the original cost minus the salvage value, which is the value, the money you'll get when you sell it, then you get the amount that will be depreciated. This is the amount that will be subjected to the depreciation method, all right, or the depreciation calculations. So these are just few terms that I wanted us to talk about before we enter into discussing um, depreciation methods. All right, so let's go to depreciation methods now. Um, so for depreciation methods, we have some which come seeded with Oracle, actually quite a number of them. So you can select to use any of these seeded methods which come with Oracle for your depreciation expense calculations. You can choose these methods as one of your methods for your assets. But Oracle also allows you to define your own depreciation methods if none of them which are seeded serve the purposes of your company to the requirements that you want. All right. So if you choose to define depreciation methods for your company, there are various type of methods that you can choose from. These are the types of depreciation methods that you can enter. You can enter what is called calculated or straight line method. We mentioned this in our previous session, whereby for the straight line, the depreciable cost is divided evenly throughout the useful period of that particular asset. All right. So if you have bought an asset maybe for $5,000, let's assume it has no salvage value, so you're not going to sell it at the end. Maybe you're just going to dispose it. So to calculate depreciation, you just subject the original cost to the depreciation method, right? So how to do this, if it's a straight line method, is you take the original cost, then you divide it by the number of years which are the useful life for that asset. So maybe that asset is determined is going to have a useful life of about 5 years. So you'll take $5,000, then you divide that by 5 years, you get the depreciation amount for every year. And then for that amount calculated for every year is divided evenly among the periods in that year. So for depreciation, you first calculate the amount for the yearly amount, then you divide that among the periods in that year. You can also have a table-based depreciation methods. When you use this kind of methods, you have when you have table-based methods, it contains some given rates in a table, all right, that will give you how you're supposed to calculate the depreciation expense for that particular asset. So for example, that table will have the amount that you're supposed to calculate for the expense for the first year, which will be a particular amount, maybe a certain percentage, all right, let's say for 20% for the first year. And then you'll have maybe 16% for the second year. In the end, those portions should add up to 100% of the depreciable cost, all right? You should expense the whole depreciable cost, right? So these tables are usually prepared by the regulating authority, the tax maybe authority in your particular jurisdiction, all right? So, and they can be defined for particular classes of assets. So maybe the IRS in the US will have a table that says how that contains certain rates of how particular assets should be depreciated. So not just maybe any table can be used for any asset. There are some guidelines that are usually given for how to go about this. Then we have a flat rate method, and a flat rate method is whereby you have a particular rate that you depreciate the depreciable cost of an asset throughout its useful lifetime. So it might sound a bit like the straight line, but it's not. This one you have a set rate, maybe like 15%, and you're going to use that rate to calculate depreciation expense for the whole period of that asset's useful lifetime. Okay. For the straight line, we started with the depreciable cost, then you divide by the useful lifetime, the number of years. Here you have a rate which you use to calculate the depreciation expenses. Next, you can have formula-based Oracle assets allows you to create depreciation methods based on a particular formula. Again, if the ones that come seeded with Oracle do not meet the needs of your company or the client that you're working for as a consultant, you can create formula-based depreciation methods by entering a formula how depreciation expenses should be calculated for the assets. Finally, we also have another method type, which is the units of production. Like the name suggests, this method is based upon particular metrics of production, okay? And you use these metrics to depreciate that particular asset. A good example is, for example, airplanes. You can use the miles that the airplane has flown for depreciation. The way you could do it is that maybe you acquire a company acquires a new plane, right? Maybe an airline, and then they say that this plane is supposed to travel at least a particular amount of miles, all right? So let's say 100,000 miles. That plane is expected to travel. That's going to be its useful production over its lifetime. So what you do is you take the original cost of the plane. If it has salvage value, you subtract the salvage value. You remain with the depreciable cost. You take that depreciable cost, you divide it by the number of those miles, okay? So what you get is the depreciation expense per unit of production, all right? So you can get, maybe you're depreciating this plane for $100 for every mile that it has flown. So how will you go about to calculate the expenses? You will go and say, okay, in the first year, this plane has flown 10,000 miles, which of course is a very short distance, but bear with me for the example. So you'll take the 10,000 miles, and then that the plane maybe has flown that year, and then you will multiply it by the depreciation per unit. All right. So if you found that you're depreciating $100 for every mile, then you'll multiply that 100 times the number of miles the plane has flown that particular year. So if it flew 10,000 miles in the first year, you multiply 10,000 by 100. Then maybe in the second year, it flew 7,000 miles. You take 7,000, you multiply it by 100 to get the depreciation for the second year. Of course, you go on and take that depreciation and divide it by the number of periods in that year to get the depreciation expense for each period. So that is the definition of some of the depreciation method types that you can create in Oracle assets. And of course, some of these methods also belong to these types. Okay, so that is the flexibility that Oracle Assets has offered in terms of depreciation methods. Okay, so far so good. Now we want to talk about depreciation accounting. So again, remember we said that we can split the functionality of Oracle fixed asset mainly into two main categories, whereby one is asset management, which consists of a number of business processes in management like addition, retirement, transfers, etc. And we also have calculating the depreciation expense is the other main function. So every period you will be calculating the depreciation expense for the assets in your books. All right. Of course, accounting is created for these depreciation entries. And so what we are trying to look at is what kind of accounting is created, i.e. the accounts which are affected when you generate these depreciation expenses. We are going to be talking about many more other GL accounts when it comes to fixed assets. But for depreciation accounting, we are going to focus on these two. The first one being the depreciation expense account. This is an expense type of account. That is the qualifier I'm talking about. How we have expense, asset, liability, etc. So depreciation expense is an expense type account. And then we have accumulated depreciation, which is what we call a contra asset account. What do we mean by contra asset account? We mean that it has the properties of an asset account, i.e. natural debit balance. Remember, the natural balance of asset accounts is debit. So when you increase your cash, for example, you're debiting the cash account, right? However, the accumulated depreciation is a contra asset. It contradicts those rules of the asset account. So it will have a credit balance. All right. So these are the two accounts that are involved when we are doing accounting for depreciation expenses. Accumulated depreciation works by helping us to avoid directly hitting the original asset cost account when calculating our depreciation expenses. Now remember these formulas that we talked about and this definition. We have the original cost, okay, and you also talked about the accumulated depreciation. All right. So when you purchase or when you acquire the asset, you will enter the original cost of that particular asset in your books. Okay. So this is where the accumulated depreciation account comes into play. So if you're affecting the accumulated depreciation, then it's accumulating some credit balance, okay, because you've said it's a contra asset account. So in the end, if you want to calculate the book value of that particular asset, then you will go and look at the value entered in the original cost account, which will never change. It will always remain there once you enter it after adding the asset or acquiring the asset. And then now you have this accumulated depreciation account, which you have been hitting every period. Okay. So whatever balance is there, you take the original cost minus the accumulated depreciation, and it gives you the book value. All right. So that's where the accumulated depreciation account comes into play and why it is useful. Otherwise, you would have had maybe to be crediting the actual original cost account. By the time we are done depreciating that asset, then we will not have, the only thing we'll be left with maybe is the salvage value, right? So instead of that, we use this accumulated depreciation account, and then we can perform this mathematical operation to obtain the book value of that particular asset. So every month, every period when you run depreciation, because this is something you have to do, actually the other asset management activities such as addition, transfers, retirement, those are not mandatory. Those just depends on whether they are required for the assets in your books. You might not have new assets to add in a period. You might not have assets to retire in that period either. You might not have any adjustments to make to those assets, but you'll always have to calculate their depreciation expenses. So when you do calculate their depreciation expenses, this is what it looks like. So for example, if this is the journal entry for depreciation expense for a particular asset for January 2019, based on your particular method, depreciation method that is, and the other values that you might have calculated, such as the depreciable cost, which is obtained by subtracting the salvage value from the original cost, right? So you've determined the depreciation that you're going to be doing for every year, and consequently for every period, by dividing that yearly value by the number of periods in the year, right? So let's say for this particular asset, that amount is 150 for January 2019. This is the journal entry that would be generated. A debit to the depreciation expense account, which we have said is an expense account. Natural balance is debit balance. So we debit this and we credit the same amount to the accumulated depreciation account. So we'll do this for January when we run our depreciation. In terms of those equations that we had, this is what would happen. So assuming that the original cost of this asset was $5,000, after you calculate the depreciation for January, which was 150, then the book value, let's say at the beginning of February, will be 4850, right? After you've depreciated this amount from the original cost. This is assuming that this particular asset does not have a salvage value. If it did have a salvage value, for example, of $1,000, then what we would have done is first do 5,000 minus 1,000, we get 4,000. Okay, and then we subject that 4,000. We subject that 4,000 to the depreciation method that we have, and then the expense that we get is what we subtract now from the original cost. Okay, so this is what the entries would look like, and this is the calculation, what the calculation for the book value would look like. So in February, what would you have? You'd have the same entry. Okay, so debit depreciation expense and credit accumulated depreciation. So at this point, if you want to make this calculation, original cost minus accumulated depreciation, then your accumulated depreciation by now is 300. Okay, so the book value of that asset is 5,000 minus 300, which gives you 4,700. So this is how we do depreciation entries, or this is how the depreciation entries are created when you create accounting for this depreciation expense. Okay, and these are the calculations these are how the calculations look like for determining the book value. Okay, so we have covered what we had aimed to cover for this lesson. So you have understood a bit more about depreciation. We learned about some few new terms that we are going to be using in the FA as far as depreciation is concerned. And we also saw how depreciation expense accounting entries are created. So, Bob, unless you have something to add, we can end our lesson there.
Thank you, Victor.